Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, September 15th. The failure of investment bank Lehman Brothers, a 158-year-old firm, is astounding, if not surprising, given all the speculation in recent days surrounding its fate. This is a firm with over $600 billion in assets, and whose stock hit an all-time high just over 18 months ago. Today, with the announcement that it will be filing for Chapter 11 bankruptcy protection, that stock is essentially worthless. This failure has mythological undertones, as it is a sobering tale of what happened after using extensive leverage in an attempt to increase profits. In essence, Lehman flew too close to the sun and got burned to death by an uncompromising market. Really, though, it was an uncompromising Federal Reserve that sealed its fate. The backstop that was made available to J.P. Morgan Chase in its acquisition of Bear Stearns was not made available to prospective buyers of Lehman Brothers, so they walked away from the bargaining table. The saddest element here is that thousands of unknowing employees of the firm are going to lose their job and a significant portion of their retirement savings, most likely, because of the mismanagement of the firm by senior officers. The Lehman situation is just one subplot in a day full of them. At the same time, AIG is said to be scrambling to raise capital, leaving one to wonder just how much longer it will be able to hold its place as a member of the Dow Jones Industrial Average. Bank of America is acquiring Merrill Lynch in a $50 billion transaction that came together in the span of a weekend. Presumably, Merrill executives saw the writing on the wall and agreed to the deal amid fear that their fate might follow that of Bear Stearns and Lehman Brothers. It doesn't matter much that the involved parties are indicating Merrill Lynch would have been able to survive the financial upheaval as an independent party. Simply knowing it worked to get this deal done in such a short amount of time was enough to unsettle the market. On top of these developments, the Federal Reserve has indicated it is extending its lending facilities to ensure there is enough liquidity in the market to handle the unwinding of Lehman's trading positions and the concomitant effects of that unwind. It is difficult, frankly, to know what to make of the entire situation. There is not much good in it, other than the understanding that there is a preeminent financial institution in Bank of America that can step up to absorb a $900 billion balance sheet. The uncertainty of the current situation will overshadow the clear strategic long-term benefits of the move made by Bank of America. The uncertainty in all of this is what is most troubling for the market. There is no telling what will unfold over the near term. Will these happenings finally mark a bottom for the sector in the market, or will there be more suffering to endure? One thing all involved parties in the stock market must appreciate is that it is impossible to pick a bottom. Bank of America CEO Ken Lewis understands the latter point. When pressed on why the bank agreed to offer $29 per share for Merrill Lynch, which closed Friday just north of $17, he astutely noted that it is impossible to pick a bottom, but that the benefits of the acquisition were so appealing that they believed it was still a compelling price. Lewis wasn't talking about the benefits over this next 6 to 9 months either, but the benefits over the next 6 to 9 years and beyond. Lewis's view is the right perspective for any investor in the current environment. The thing about market bottoms is that you don't know them when you see them. Only in hindsight can a market bottom truly be identified. Technical analysts could very well be right in their thinking that we could go back to the 1200 level or lower before a bottom is hit. Briefing.com does not know if a bottom has been reached, although we believe the risk-reward profile for the market has tilted in long-term investors' favor with the bear market retreat. Valuation is reasonable, economic growth is better than feared, inflation pressures should moderate, and earnings growth should pick up noticeably in 2009 as the financial sector continues to cycle some ugly results that started in the third quarter last year. There could be another 10 to 15% slide in the market, but ultimately if there is 40% upside or more from the current level, that's an acceptable risk for investment-minded individuals who should not concern themselves with trying to time the market and should not be led into panic selling by some jarring headlines out of the financial sector. Good things take time to work out. From the panic of 1907, though, to the depths of the Great Depression, to World War II, to the Kennedy assassination, to the OPEC oil embargo, to the crash of 1987, to the S&L crisis of the early 90s, to the attacks of 9/11, the stock market has been an inexorable wealth creation machine. Some periods are more challenging than others. This is one of those periods. History has shown time and again, however, that it has paid to be patient and to remain invested in the stock market. We can't pick the bottom, but we can fall back unabashedly on that fact. I'm Pat O'Hare for Briefing.com. Thanks for listening.